Hi. All right, today I want to do a short case on Apple Computer. I touched on Apple in my VALUEx presentation, which I posted last week, and I thought it would make sense to come back to it, just flesh out some of the ideas that I shared. I only had a couple of slides on Apple in that presentation, so I wanted to talk about it in a bit more detail. Now, it's Berkshire's largest public holding, so it's kind of continuing with the Berkshire annual meeting theme. And I think that would be kind of fun to look at. Now, what I want to do is use some of my value of growth tools as we look at Apple. Now, most people watching this video will be very well acquainted with Apple as a company, so I will not spend really any time talking about their products or services or anything. I'll assume you know that. We can come back to it in a future video if it makes sense or I get a lot of input, but otherwise. So what I'm going to do is use as I said, my value of growth tools to look at Apple as an investment and what the stock is telling us. All right. Now, for those of you that follow Apple, it's been a huge stock over the last 10 years. You could argue it started $20, $30 on the current share base, and it's been as high as $200, which is amazing. The company's really done a fantastic job. Give Tim Cook tremendous credit. Took over after Steve Jobs passed away, and he's executed beautifully. Two-year chart is more interesting. It had a better last year than it has this year. It's been kind of choppy for almost a year, as you see in the one-year chart. Now, it's funny, this stock, for being well owned by a gazillion people, almost everybody owns it, this thing gaps up and down a lot, which is kind of crazy. You would think that it'd have a smoother sort of trajectory. I will posit in this video, kind of develop the theme that there's a lot more going on in Apple than meets the eye in terms of valuation, and therefore some of these gaps might make sense. Now, the most recent gap over here was when the company announced what was basically a disappointing quarter. We'll talk a little bit about that. But they also announced $110 billion share buyback, which is, you'll see as we go through the analysis, one of the key drivers to the stock. All right. Apple, kind of cool. It was the first $1 trillion market cap back in 2019. It was the first $2 trillion market cap back in 2022. It's got a lot more competition for the 3 trillion mark, because we've got Microsoft and other companies vying for that as well. All right, fantastic business. Return on capital is astronomical, as you see in this table. Now, a big part of that is Apple. Tim Cook has convinced another company, Foxconn, to essentially manufacture the bulk of their products. And Foxconn has invested hundreds of billions of dollars. I suspect they have $100 billion in invested capital. I am told from people that have studied Foxconn that the return on capital is probably in the 4 to 5% range. I don't know that for sure. Some of you watching this might know more about Foxconn's financials. Drop a note in my YouTube channel would be great. And because almost all of the manufacturers outsourced, the return on capital for Apple is really impressive. If you smash the two companies together, Apple and Foxconn, back of an envelope would suggest the return on capital is about 25%, which would make sense. All right. Now, as I talked about in my competitive advantage lecture last week, we can split the return on invested capital between a profitability and a capital efficiency or scale. For Apple, it's kind of hard to see, but you'll see that the margins, profitability, are very impressive and have only gone up over time. In 2014, they were 21%. This is all highlighted in blue, middle of the table. And in the most recent 12 months, that's what LTM is, the final column, they're at 26%. The revenue per scale is off the chart. It started at 8, 9. It's been as high as 10. Right now, it's running just below 9. And when you multiply those two, you end up with this phenomenal return on capital. The magenta color is that scale. That's revenue divided by invested capital. The blue down at the bottom is no-pat margins. And you can see that the company is just extremely well managed. All right, so this is Apple's enterprise value over time, and you can see that it's increased fairly dramatically. In the most recent pricing, it's about $2.7 trillion. One more time, LTM is last 12 months. Apple has a September fiscal year, and we've got 6 months since the end of the fiscal year, so it makes sense to do an LTM in addition to the fiscal year. Interesting, tying this back to Buffett. Buffett made his initial purchases at the end of 2016, early 2017. That's his big commitment. I'll show a chart on that momentarily. And you can see that the enterprise value has increased 3.5 times in 6 years, proving once again Buffett is a fantastic stock picker, even in technology, it looks like. Now, one of the things that has driven Apple stock is they buy back a lot of stock, a lot of shares. And so we go back to 2014, they had 23 million shares outstanding. At the end of, at the beginning of 2014, they had 23 million shares outstanding. At the end of fiscal year 23, it's down to 15.8 million, a decline of almost 33%. That's been an important part of the stock driver. Now, this is your enterprise value per share. We see a similar trend. Obviously, it's increased dramatically over that period. It's gone from 31 to 171. That's your enterprise value per share. Ties in with the whole story. Not just the enterprise value gone up, but the enterprise value per share has gone up a lot. All right, so this is a table that I refer to as the Italian cookie because of the colors. Invested capital is always in red. Present value of competitive advantage is in blue, and the market implied value of growth is in green. I'll go through this analysis or the background on this analysis in a future video. But the way you want to think about it is earnings power value is essentially the most recent a NOPAT, the most recent NOPAT the company reported, capitalized by their cost of capital. And throughout this, I'm just using 10%. We could use a different discount rate. I'll talk about discount rates in a future video as well. And then if you take the enterprise value and you subtract off the earnings power value, you're left with the market implied value of NOPAT growth, which is investors' expectations of future growth of NOPAT. And then we highlight this. I'll show you in detail. So this is, as of yesterday, I repriced it. So they have about $43 billion in invested capital. Their earnings power values $1 trillion. That's just the most recent most recent annual NOPAT. This is LTM, capitalized. The difference between invested capital and earnings power value is the cash flow derived from excess returns. I touched on competitive advantage a bit last week. I'm going to go into more detail in future videos. If I take the enterprise value and subtract off the earnings power value, I'm left with the market implied value of growth. So in the most recent period, just capitalizing everything, 63% of the company's value is in market implied value of NOPAT growth, and 36% is in earnings power value. All right, so this is what this table here looks like when you graph it. Green is your market implied value of NOPAT growth. Blue is the present value of competitive advantage. That's those excess returns. And red is your invested capital. All right, I'm going to play with this. All right, here's your earnings power value over time for Apple. And what you see is there was not much change from 2015 to 2020. Earnings power value didn't change much. I'm using the same discount rate for all those periods, so that means that their NOPAT showed very little growth. However, we go into COVID and they showed tremendous growth. I think a lot of people upgraded their computer systems during that period. I certainly did. I think other people did as well. And post-COVID, it's not really done anything. So from an earnings power value, the company hasn't been that impressive. But keep in mind that enterprise value has gone up. And that's your earnings power value per share. So again, we've a steady increase from 15 to 20 because of the share repurchases. Big jump in 21, both share repurchases and that COVID upgrade cycle. And then not much earnings power value increase since 21. However, because they continue to buy back stock, earnings per value per share has trended back up after dropping in 22. All right, there's your market implied value of NOPAT growth. That's the difference between your earnings, the enterprise value, and your earnings power value. That's this same amount just graphed by itself. And you can see is that the market implied value of growth, this is investors' expectations of future growth, has increased dramatically. It's increased essentially tenfold from 2018. So earnings power value has gone up a bit, but what's really driven this stock is market implied value, NOPAT growth. This is future NOPAT growth. This is what investors are willing to pay for. And if we look at it on a per share basis, you can see that this has been the story. The big story at Apple is the dramatic increase in the market implied value growth per share over the last 10 years. That's what's driven the stock. Now, this is earnings, this is investor expectations about future performance. So what's embedded is pretty high expectations, and we probably need to tease that out a bit. All right, here's your Berkshire purchases. Huge commitment, as you see in the early periods, 16, 17, and 18. And then since then, they've trimmed the position a bit. They bought a bit more back in 23. And then they announced most recently a fairly large sale in the first quarter. So there's your initial commitment. That was big. And by the way, stocks performed exceedingly well. I applaud Buffett, continues to be very impressive. And then they sold 10% of the position without really much of an explanation. Berkshire said that Apple will always be a permanent position. However, he sold some, I guess, because he said they wanted to have a bit more liquidity on their balance sheet. All right, that's what he said. All right, so now there's Buffett's initial purchase in 2016-17. And what he essentially was buying is a stock that had about 20% of its value based on future growth. And at the time, the company did not demonstrate a lot of growth, nor did it grow a lot, its earnings power value anyway, over the next couple of years, although earnings power value per share did go up because of the share repurchase. However, you can see that, however, the market implied value growth for the company has increased dramatically from just under 20% to almost 60%. It's kind of been held steady there. Huge increase. So Buffett bought a stock that he thought had long duration cash flows, probably right. Thought the franchise was in great shape, probably right. He also bought a company that was going to buy back a lot of stock. And if you as a shareholder think the stock is cheap, which Buffett did, company buying back stock with its excess cash makes a lot of sense. I think that was the original thesis, and it played out beautifully. The thesis now is very different. Buffett sells his 10% position with a valuation that has 60% market implied value growth. Now, they're going to buy back stock for sure, but earnings per value on its own is probably not going to go up much over the next couple of years. The share repurchase will increase the earnings per value per share. That should probably work out well. But now you're dealing with a company with high investor expectations for its future growth. And I think that's what Buffett sees. He may need liquidity, but that's what Buffett sees. All right, so here's your revenue over that period. They've grown. Most of the big increase came in COVID, and then they kind of held that level. There's your annual growth rate, however. In COVID, 33%. And recently, pretty unimpressive. A lot of people love Apple, but the actual numbers have been somewhat unimpressive. Perhaps there are a bunch of new products coming, but at the moment, they're not showing very impressive year-over-year growth at a time when investor expectations of future growth has never been higher. All right, and there's your product year-over-year growth. You see the spike in COVID. We're now actually negative, significantly, almost double-digit negative in the first calendar quarter of the year, 2024, the second fiscal quarter. So the challenge for all the people watching Apple is where's that growth going to come from? Because that is embedded in the stock price. You're already paying for that. Perhaps it's services. Services have grown significantly over the years and had a good first quarter, although services are still only about 22% of revenue. So services could bail them out over time, but from a pure product perspective, hard to see a lot of growth in Apple over the next couple of years at a time when the market implied value of growth is at an all-time high. All right. Thank you very much. Appreciate you watching.